to another tutorial video. This time around, we're going to be addressing a very important topic that pretty much every other source I've seen on financial modeling overlooks, which is how to consolidate the financial statements for projection purposes. So the motivation for this question is that over the years, we've gotten a ton of emails from people saying things like, oh, help, my balance sheet doesn't balance. I don't know how to link this item to this item. I don't know exactly how to do this. I'm stuck at this point in the model. I can't figure out how this links in, or my balance sheet is off by 5.1 each year and I don't know what's going on. And the real answer to this, as you can see here, is that you probably started out the wrong way. So if you start out with the financial statements in the wrong format, you're going to have an exceptionally difficult time getting the balance sheet to balance and also projecting many of the line items there. So a lot of people, for example, will come up with a very complicated model with hundreds or thousands of rows, maybe something like the one that we have on screen right now. They'll have a moderately complex balance sheet. They'll get to the bottom and then realize that assets do not equal liabilities plus equity. And then they'll have to go through this complicated exercise of checking every single line item on the cash flow statement and checking all the numbers here against the items on the balance sheet and trying to find that one item that's not linked incorrectly or that one item that's double counted or something like that. And the truth is that if you set up your model correctly, you can save yourself a whole lot of time and effort by simplifying and consolidating the financial statements first. So we're going to go through an example here using Chipotle, and I have linked to a PDF of their financial statements and also the Excel formatted statements, which are not in the best format, but at least you have all the data there in Excel. So I've linked to both these below in case you want to practice with this. What I want to do first, though, is just briefly go through the process that we recommend following for consolidating and simplifying the statements. The goal should be that each item on the balance sheet will have a corresponding item on the cash flow statement and vice versa. So if you run into a situation where, for example, you have an item on the balance sheet and you cannot find a matching link on the cash flow statement, then you need to either add that link on the cash flow statement, you need to add something that corresponds to that item, or you need to consolidate the balance sheet item. You see this in a lot of cases with items like other assets, other liabilities, miscellaneous smaller items like different types of investments, for example. Rather than torturing yourself trying to figure out exactly where every last little thing goes, consolidate, simplify, and move on. Really, the key drivers matter most, and outside of that, outside of what's driving revenue, expenses, and capital expenditures, and to some extent working capital for companies, a lot of those smaller items just don't matter enough to obsess about. Now, our rules of thumb for doing this. So first off, when you're going through and entering the statements for use in financial projections, you want to hard code all the historical numbers. Now, a lot of people approach this incorrectly. And what they'll do is, you can see here I've input Chipotle's numbers into Excel. What they'll do is they'll look at something like their financial statements and then say, you know what, I'm so smart. I am going to go over here to the cash flow statement, go to where they have the changes in operating assets and liabilities. And, to check my work, I am not going to enter it like they have it listed on the cash flow statement. I'm actually going to do the math. So I'm going to look at the real change in accounts receivable on the balance sheet and then plot that on this cash flow statement. Well, as you will quickly find out, this never works. To illustrate, let's just go to Chipotle's statements and see why this is the case. So let's take a look at their change in accounts receivable first. Goes from 16.8 to 24. So what is the difference there? Well, it's going up. An asset's going up, so it's a use of cash. What does that come out to? 16.8 minus 24.016. That comes out to negative 7.216, but not the same as this number. This is actually negative 7.238. So this is a very minor difference, but this just illustrates the point that you cannot do that. Companies group items differently, and so we always recommend simply hard coding all these historical numbers. So once you've done that, next you want to think about the income statement. And for 99% of companies, you can pretty much keep the income statement as is. So over here for Chipotle, we're going to make one minor change to the income statement, but other than that, it's going to stay pretty much as is because for the most part, revenue and expenses, the way the company lists them, that's the way you want to project them. So food and beverages and packing, labor occupancy, you should probably be projecting these expenses all separately and thinking about how to do them separately. Now, the balance sheet and cash flow statement are a little bit trickier to describe, but here's the basic idea. First off, if the company is doing something odd on its cash flow statement, so for example, it's using the direct method, or it starts with operating income rather than net income, or anything else like that, you have to adjust it. Now, we're not going to go through that here because Chipotle doesn't use the direct method or do anything weird. It's a US based company. Its cash flow statement starts with net income. But if you have something like that going on, very common with companies outside the US, you'll have to adjust and find the reconciliation in their financial statements first. Now, once you've done that, what we recommend doing is checking the balance sheet against the cash flow statement to figure out which link should go where. For example, you could look at this company's balance sheet and say, okay, accounts receivable, do we have something that matches on the cash flow statement? And the answer is yes, we do. We have the change in accounts receivable right here. So we could check those two items off and say, okay, we know exactly how they're going to link together. We're done. On the other hand, if we find something like the current deferred tax asset, this has no clear item to link to on the cash flow statement, so it's telling us that we probably have to consolidate this with something else or add a line item on the cash flow statement for this current deferred tax asset. So I'm bringing this up because, again, you want to do this and complete this exercise before you start projecting anything, or your life is going to be much more difficult. As I said here, when you find items that don't match up, you have to either consolidate them or possibly add a corresponding entry or corresponding line item on the other statement. And then finally, at the end, you want to check that the location of different items makes sense. So again, this is not too relevant for a company like Chipotle, but if you were dealing with a non-US company, some company that follows IFRS, you'll see a lot of items such as dividends showing up in weird sections. Some companies may even list them in cash flow from operations. A lot of companies will list investment related items within cash flow from financing. So feel free to move those around. As long as the net change in cash at the bottom is the same, it doesn't really matter where these are listed all that much. So now that we've been through that, let's go through this exercise for Chipotle's statements now. And again, you can follow along or try this yourself afterward. I'm going to go through it now and explain how we would go about actually consolidating and simplifying the financial statements here to make our job of projecting them easier. I'm going to go through this and pretend as if I were you just going through this and copying and pasting everything down. So I just copied and pasted this. What do we start with here? Well, on the income statement, really there's not a great reason to change much of anything up in this section. And even going down here, there isn't really a great reason to change anything. Everything here is pretty clear. The one change I will make is to add in a goodwill impairment charge over here. The reason why we're adding it is because if goodwill is impaired, it's going to show up on the income statement. It's also going to show up on the cash flow statement. And typically, goodwill is not already linked to anything and does not have a clear link on the other statements. So we like to add that in just for added flexibility. Not 100% necessary, but I'm going to go through this exercise here. So goodwill impairment. And let's just fix the formatting here. I'm going to say 0. And if there's an impairment charge, we're going to record it as a negative. So for pre-tax income, we're just going to add the goodwill impairment up here and then add the interest income or expense to get that. So that is the one change that we have made right there. We don't have anything else to change. So let's move over to the balance sheet and cash flow statement and go through this exercise of figuring out what needs to be consolidated. Let's start at the top of the balance sheet and then go through the cash flow statement, try to find the corresponding item. If we can't find it, then that means that we need to change something on these statements. Cash and cash equivalents, this one is always going to link to the bottom of the cash flow statement, so we actually don't need to do anything here. I'm going to highlight this in yellow to show that we have a corresponding item. So cash and cash equivalents is going to correspond to ending cash at the bottom. Accounts receivable. This one, again, has a corresponding item in this section for changes in operating assets and liabilities. So we can just highlight that in yellow and highlight this change in yellow on the cash flow statement. Inventory, same idea. Let's highlight that in yellow and highlight this one in yellow. Nothing special or fancy there. Current deferred tax asset. So now we run into our first problem on the statements. Here's the issue with the current deferred tax asset. You might look at the cash flow statement and think, okay, well, it's easy. It matches up to the deferred income tax provision or benefit. We learned this before. We learned how this works. We learned how you can model it as either an increase to a deferred tax liability or a decrease to a deferred tax asset. The problem, though, is that we also have a deferred income tax liability, and we cannot have these two separate items linking to this one item on the cash flow statement, or at least we probably should not do it like that. So we end up with sort of an extra item here. The easiest thing to do in this case is to actually consolidate it with the one right below it, the prepaid expense and other current assets line item. You could even consolidate it with income tax receivable. It doesn't really matter, but it needs to be consolidated with one of these items because both of these, prepaid expenses and income tax receivable, these are shown explicitly on the cash flow statement right here. So what we're going to do is consolidate it with prepaid expenses. So 13.212, let's just add these up and copy and paste these as values and delete the current deferred tax asset. And I can just add a footnote here, consolidating DTA with this line item for simplicity. And again, this is an item that's so small that it really doesn't even matter what we do for the projections anyway. So we've done that, we've consolidated it. Let's just check our balance sheet still balances. And so what we can now say is when we're projecting this item, we're grouping those all together. I'm going to highlight this in yellow, and then we're going to highlight the same area in yellow on the cash flow statement right here. Let's keep going down. Income tax receivable right here. Well, this one's pretty easy because it's just going to line up with the change in the income tax payable or receivable on the cash flow statement. So we can highlight this in yellow and then highlight this one in yellow. Now, if you look on the liability side, there is no line item for this, so it's actually very easy. We're just going to link directly to this item right here, and that's all there is to it. So we're pretty much done with this section. The last one, investments. The problem is that we do have purchases of investments and maturities of investments, but we also have this item, long-term investments under long-term assets, and these are probably going to link to this long-term investments line item. So one solution here is the following. We have this other item, acquisition of interest and equity investments. We could rename this, and we could just say changes in short-term investments, and have that. Keep this to 0, and then what we can do is go up here and just rename this to short-term investments, because that's really what it is if it's under current assets. So now this line item under cash flow from investing activities will link to our short-term investments. Remember that as we covered in the accounting lessons, it's not going to be a one-to-one match between current assets and changes in operating assets and liabilities and cash flow from operations. What usually happens is that cash will flow in from the bottom and investing related items will flow in from the investing activity section. So just be aware of that. A lot of accounting textbooks say, oh, investing activities always corresponds to long-term assets, but that's not really what happens in real life. In any case, though, we are now done with this. So we're going to highlight this one in yellow to indicate that we now have a proper link, and highlight this part in yellow as well. Now, long-term assets, let's move this up a little bit and see what we can link in here. So net PP&E. A couple things are going to link to this. I'm going to highlight this in yellow because this one is very, very easy to link for the most part. What's going to link in? Depreciation and amortization. They're grouped together here, so we're just going to link both of those to net PP&E. Loss on disposal of assets. Any type of disposal of asset item is going to link to PP&E as well because that's what it is referring to. And then CapEx, capital expenditures, are also going to link to PP&E. So we can highlight all those items in yellow. We know exactly how the links here are going to work, and everything lines up. Long-term investments. This one is going to correspond to the purchases of investments and maturities of investments in the cash flow from investing activities section. And this is one case where cash flow from investing activities does actually correspond to long-term assets on the balance sheet. So this link is also fairly straightforward. We're just going to color this yellow once again and color both of these yellow. So we're actually done with the investing activities section, and we know what everything here is going to link to. We're also going to rename these to long-term investments just to clarify exactly where they link in for someone else looking at this later on. Let's keep going. Other assets. So again, here it's an exception to that so-called rule that long-term assets always corresponds to cash flow from investing activities. It's not the case. We don't know what's in these other assets, but we do know that the company considers these an operational item, not an investing or financing item. So just an exception to be aware of, that you have to follow the company's treatment, not what accounting textbooks tell you about this stuff. Since it is an operational item here, we're going to assume that this change on the cash flow statement corresponds to this item under long-term assets. One change I will make is I'm going to rename this to other long-term assets, again, just to clarify exactly what it links into and to give a more specific name. So I'm going to color this yellow and color this yellow as well. So we have that. Last item here is goodwill. This does not link to anything right now, but we can fix that by adding the goodwill impairment line item right here in the adjustments for non-cash items. So what I'm going to do is take everything here and just cut and paste it down one row, and we can say goodwill impairment. We're going to link to the negative of the number on the income statement over here because we're flipping the sign here. If this was an expense on the income statement, we'd be adding it back on the cash flow statement. We have this, and with that, we now know exactly what goodwill links to, so I'm going to highlight this in yellow. And as you're going through this, it also helps to write notes by the side about what you're going to link each item to. I'm going to paste in all my notes at the end just to save us some time in this exercise and just so you have it for your reference. So now we're done with the asset side. We know that each item on here corresponds to one item on the cash flow statement, and each of the items highlighted in yellow on the cash flow statement will correspond to an item on the balance sheet. So we're set and we know exactly how to project our statements, and we haven't really made that many modifications to this set of financial statements. So now let's turn our attention to the liabilities and equity side, which is a little more challenging in some ways, but also easier in some ways. Let's start from the top with accounts payable under current liabilities. So this one, again, very easy because look at this, it's an exact line item on the cash flow statement. So this one we can highlight in yellow because we know exactly where it is going to link up. Now these next two items, accrued payroll and benefits and accrued liabilities, we have this line item for accrued liabilities, but look at this, we have nothing for accrued payroll and benefits. What do we do in this situation? As you probably guessed, we are just going to simplify this by consolidating these two line items, and then we can make both of them be reflected in this one line item on the cash flow statement. Now, if you wanted to, you could have another item for accrued payroll and benefits and put it right under accrued liabilities here, but generally speaking, we think it's a little bit easier to consolidate the balance sheet and keep the cash flow statement more as is than it is to do the opposite, but you could take that approach as well. So I'm going to call this one now accrued liabilities, payroll, and benefits. And we're going to add up our accrued liabilities right here. And we have this annoying warning about circular references. What I'm going to do here is copy the same name over here, accrued liabilities, payroll, and benefits, so we know exactly what it is linking to. And we're going to color this yellow and color this one yellow as well. So we've now greatly simplified the current liabilities section, reducing the items by about a third there. Let's keep going down and see what else we have. So long-term liabilities, deferred rent, deferred income tax liability, and other liabilities. What links to what here? Well, deferred rent, there's an exact item on the cash flow statement that corresponds to it. So we highlight this one in yellow to say, yep, we know exactly where it's linking in. We highlight this on the cash flow statement in yellow as well. Deferred income tax liability, if you go up, we have deferred income tax provision in the non-cash adjustments section. So again, we know exactly what this links to. I'm going to color both these in yellow. Other liabilities. Once again, even though this is a long-term liability, the company considers it an operational activity over here. So I am going to color this one yellow as well and color this one yellow as well. And I'm also going to go in and change the name, again, just to be perfectly clear about where this is linking to so there's no ambiguity later on. So we have that. Now looking at the cash flow statement, we have a lot of these items filled out now. The remaining ones here, bad debt allowance, stock-based compensation, excess tax benefits, other, and then all the financing activities, acquisition of treasury stock, employee stock plan transactions, excess tax benefits, and other financing payments. And then also effective FX rate changes on cash. A lot of these are going to link to the shareholders' equity section, but what exactly would we simplify and consolidate here? Well, to be quite honest, if you wanted to, you could consolidate this whole section. So you could take this whole section and say, you know what, let's not even worry about showing these separate items. Let's just show shareholders' equity by itself and simplify it and make our lives a whole lot easier. And that would be perfectly fine. If you are really time pressured, I actually recommend doing that. But we're going to take a slightly more advanced approach. What I always recommend doing for the shareholders' equity section is consolidating common stock and additional paid-in capital, because there's really no point in showing them separately. There's such a small difference. It's just a pain to keep track of the par value of common stock issued versus the market value at the time it was issued. So we almost always prefer to consolidate these items. Let's take the common stock and add APIC down here and copy and paste that as values and then get rid of that. So we have that. Now what is common stock and EPIC going to link to exactly? Well, we're going to highlight this in yellow because the links, again, are going to be fairly straightforward. One thing it's going to link to will be stock-based compensation over here. Another thing that it's going to link to will be the proceeds from employee stock plan transactions. We don't know exactly where it's going to go, so we're not going to stress out about it because it is 0.3 on a company that is doing 3.2 billion in revenue. We have an item that is worth about $300,000 here. Does this sound like something that's worth worrying about to you? The answer is no. You have to use your brain with this, and if something is small, don't stress out or hyperventilate about where to link it in. If it's small, it doesn't matter that much anyway. So that's what our link for that is going to be. Treasury stock. This one is very easy once again. Acquisition of treasury stock. Basically share repurchases right here. We're just going to link to that. We'll color both those yellow. Accumulated other comprehensive income. The only thing here that's going to link in is the effective FX rate changes on cash. We don't have any pension related items. We don't know what the unrealized gains and losses look like, so none of that's going to link in here. Retained earnings. So this one is going to be linked to our net income at the top. And that's how that flows in. We don't have any dividends here, so we don't have anything like that to worry about. And now we know exactly how these items are all going to line up with the balance sheet. Now there are a few problems remaining, namely that we don't know exactly where a few of these items on the cash flow statement will link to. So the bad debt allowance, excess tax benefits and other, and then going down, excess tax benefits and other financing payments. What do you do with these? Let's start with the easiest explanation first. Excess tax benefits on stock-based compensation, this doesn't need to link to anything. So I can actually color this yellow. The reason why is that we have it up here in cash flow from operations, but then down here it is reversed in financing activities. So take a look at this. It's negative 38.4 here, and then down here it's positive 38.4. The charge cancels itself out, and we don't have to link this to anything because we have it once, and then we reverse exactly what we had on the cash flow statement. So that's easy. We don't have to link that to anything. What else? Bad debt allowance and other. For this one, we would probably say that it is best to combine these into a single item. I'm going to call this item other items. And let's just take the number here and add the other line item here, copy and paste this as values, and then delete this line item just so we have less to worry about linking. So we have other items. And then if you go down here, we still have other financing payments. So what do you do with these items and how do you decide to link them? Well, to answer that question, again, I invite you to look at the magnitude of these. Negative 0.1, so negative 100,000, and then 0.5, so 500,000. Again, order of magnitude test. Do you really think they matter for a company that is earning $3.2 billion in revenue and that has net income of $327 million? These items are so small and insignificant that you could almost make an argument for just grouping them with one of the other items up here. Same thing for financing activities. You could even group this with one of these items if you really wanted to. But what we would probably say is that both of these items should be linked to retained earnings. If you don't know where something should go, retained earnings for very small items, it's okay to link it in there because these types of items are probably going to affect shareholders' equity in some way. So we would say for both these, this one, other financing payments, should probably be linked to shareholders' equity. If we had debt, we might link it to that instead. And then other items, we would just simplify it and link that to retained earnings under shareholders' equity as well. So we're now effectively done because we know exactly where both these will link to. And again, I would recommend actually when you're going through this, making notes about those links. What I'm going to do now is a bit of a cheat. I'm going to go over to my finished file in a separate window and just copy and paste in all my notes into this after file so that you have them for your reference. So here are all the notes I just pasted in, and I've just clarified all the links and where everything here goes and how these items flow into each other. So that's it for our tutorial here. Hopefully now you should have a better understanding of how to consolidate and simplify the financial statements, and also just in general how you can check your work as you're going through it and ensure that everything matches up to something else on the other statement, whether you need to consolidate items or add new items or anything else in between.